Thanks, everyone. Thanks for having me here today. I guess kind of had a little bit of background, but yeah, I'm Ryan Stevenson. I'm with KPMG in Lethbridge. I'm a senior manager in our tax group. I've been working in the ag space for about the last 10 years and have an ag background. I grew up on the family farm in Saskatchewan. What I came to chat a little bit about today was some of the proposed changes. So I'm sure most of you have heard a lot in the media in the past few months about the proposed tax changes, some of the issues, some of the inability to pass the farm down to the next generation, a few things like that. Now, this is an evolving topic, so we still actually don't know, because they backed off on a few of the proposals that they had put out, what the rules are actually going to be. We know what they say they are not going to do, and we know what they said they were going to do before, and what they're going to try to continue to work with. So I'm going to start, I guess, a little bit with kind of the background, what's happened, and then kind of get into some of the proposals that they did put out, which they say they're going to tweak but are still going to enact. So there's, I guess, three issues that I'm going to cover. One is tax on what's called split income, some changes to the small business deduction, and then tax on passive income. So the background is back in March in 2017, so this year, the federal budget announced that they were going to do a review of private company taxation. So we didn't know what that meant. A lot of us kind of assumed that they were just going to look at how the small business deduction works, which is definitely not where they went. Then on July 18th, they released some draft legislation, which I think caught everybody by surprise, and this is where we started to hear about this in the media. So they had a whole bunch of proposed changes, and some of it made some estate and some tax planning that we were used to extremely difficult to work with, as well as limiting some access to the lifetime capital gains exemption, and basically eliminating a lot of planning that we used to be able to do. Up till October 2nd, they took submissions to explain from, I guess, the practitioner side, as well as other business individuals, their comments on what the proposed legislation was. And they've taken those comments and basically said, okay, well, we're going to eliminate a lot of the issues that we talked about surrounding the lifetime capital gains exemption and what they called surplus stripping, which is some planning that we used to be able to do to eliminate some tax. What they did say they're going to go forward with is tax on split income, as well as some changes to how we're going to tax passive income. Right now, like I said, we're currently waiting to hear back from the government on what the draft legislation is actually going to look like. So this isn't necessarily what it's going to be. It could be drastically different, but this is our best case scenario as of today. So the first thing is this concept of income sprinkling. Okay, so basically, in the past, what we've always tried to do when we set up corporations and other things like that is try to spread the income out amongst the family as best we can, so that we're constantly taking advantage of what we call the lowest marginal tax brackets. And so that concept is, it's better for everybody in the family if there's 4 of you to make $50,000 than 1 to make $200,000 because of these lower marginal tax brackets. So under the current rules, you basically were able to do this type of planning as long as there was no minors in the family group. So if you had individuals under 18, you couldn't pay them dividends, you couldn't give them allocations from partnerships, they couldn't receive a non-arm's length capital gain, so a capital gain from a transaction with someone that's related to them. And as long as that wasn't the case, you could still pay them a wage as long as it was fair market value for what they were doing. You didn't have this split income. So really, as soon as you turned 18, we could start paying you, and it was fine. Under the new rules, they basically expand this concept that they used to refer to as kiddie tax. So, and they also now refer to it as this tax on split income. So the definition is extremely complicated. I'm going to try to go through it with a couple of pictures so that you can kind of get a sense of will this affect you or not. But it's definitely something, once this legislation comes out, that you're going to need to go and talk to your advisors about. It's definitely going to be a drastic change from what we're used to and how we've done some tax planning in the past. So one of the important concepts is a specified individual, which used to just be someone under 18. but now it can basically be anyone that's related to you. There's some very specific rules for that person that's related to you if they're between age 18 and 24. And the big concept that they talk about here, if you're talking about just like an overall 1,000-foot view, is reasonableness. So basically they need that income that you're paying to that person to be reasonable based on what they're doing. And it's going to be a significant impact. So if you were to say looking at someone that pays their marginal tax rates up to $200,000 of income versus if that $200,000 became split income and taxed at your highest rate, it's about a $32,000 difference in tax per person. So it can be significant depending on the type of draws that you're taking out of corporations or partnerships. So who's affected? So this picture is going to kind of be important to the talk in general. So down here you have your corporation or partnership or trust that's allocating income to a specified individual. So a specified individual then falls into categories of under 18, we know we can't do anything. 18 to 24, we know we can do some, but we have some restrictions. And then over 25, again, different restrictions than between the 18 and 24 group. So then a specified individual then needs to be related to this concept of a connected individual. So the related basically is all your immediate family, but then it extends now to aunts, uncles, nieces, nephews, etc. So it's a really broad scope. And then a connected individual isn't just necessarily the shareholder of the company, but there's a number of different factors that will determine whether you're connected or not. So I'm going to go through each topic, like a specified individual, and then what a connected individual is, as well as what split income is as we go through. But try to keep this picture in your head as I'm talking. So an example of a specified individual. So in this case, husband and wife both own shares of the operating company. The husband has 90%, the wife has 10%. The husband's actively involved in operations day to day, and the wife is not. However, in this case, they're actually both specified individuals. So what you need to look at basically is if you have a 10% shareholding in a company, you're specified. So you're one of those people no matter what, and then anywhere up from that. So it's very important just to consider if you have more than 10%, you're automatically a specified individual. So split portion. So this is, again, the new concept. So this used to just be for under 17, now it's for over 18. And it basically comes under this reasonableness test. So as long as what you're paying them is reasonable, it's not split income. But if any portion is deemed not to be reasonable, then it now becomes part of this split income, and it's automatically taxed at the highest marginal rate. So in Alberta right now, that's 48%. And now we'll need to kind of look at what they consider counts for whether it's reasonable or not. So they've come out and said there's a number of different factors for what matters of whether it's reasonable or not reasonable. So the first one is labor contributions. So a labor contribution, they're going to look at, how old is the individual, what are they doing in the business, what's the type of business, is what you say they're doing for the business reasonable, would you pay that to an arm's length third party to do that same job, all these types of things. Capital contributions is going to be a little different. So part of that's going to be what you've contributed in terms of your shares, which most of the time in private company situations, we've put very nominal dollars into our shares. They're $1 a share, and you have 100 of them, and there's not very many. So that's going to really restrict what your capital contribution is. Now, they may look at what's called a shareholder loan, where you loan money into your company and consider that capital, but they're quite vague about that in the draft legislation. Another concept that they talk about is risk assumed. So risk assumed is just basically, that's all they've told us is risk assumed. So we have absolutely no idea what that means, but it's one of their measuring tools that they're going to look at. And then the other one that's also very vague is they're going to look at what the total amount that were previously paid or payable to that individual is. So again, very vague. If in my example, the husband had always taken out $100,000 and so had the wife, is that going to mean that they can always do that for forever? We don't know because of how vague that they're being with this with the draft legislation. So, and just part of the reason that there was a lot of discontent with the tax practitioners was how vague the rules were. And so when they say they're going to take a look at this and release new draft legislation, one of the big things that they've talked about is they're going to clear up what these reasonableness rules are. But again, at today's date, we don't know because we haven't seen that new draft legislation. Then the other one is the connected individual. So if we go back to our triangle, we had the specified individual up at the top corner who was getting the income, and then we had the other person that was influencing the corporation. So that doesn't necessarily just mean that they own the shares. There's a number of different factors that they're going to look at for that person to determine if they're connected. So the first one is strategic influence, which is, more simple. Do you control the corporation in fact or in actuality? So actuality being I own 100% of the shares, I control it. In fact, meaning even though my spouse owns 100% of the shares, I make all the decisions and I decide everything, so I still control it. The next one is equity influence. So in a common example that we might see in here is, a parent has a bunch of preferred shares that have a whole bunch of value, and the kid has new common shares that are, nominal value. And ultimately, the parent, because they own most of the value of the corporation, still has an equity influence. An earnings influence basically is, again, we'll look at the husband-wife situation. Wife owns shares. Husband takes all the income out as a salary out of that company, while the husband now has an earnings influence. And then an investment influence is basically they have more than 10% of the fair market value of the company. So you could have no shares, but a giant loan in there, and ultimately you have control because the company owes you a whole bunch of money. Well, now you have an investment influence. So if you have any of these factors, which again are extremely subjective, and we don't really know what the tests are going to be, this is how you become a connected individual. So to kind of recap, basically if you're under 18, basically you either have to have reasonable salary or you have to be selling to a third party, or you can't have income to somebody under 18. If they're over 18, now you have to go through all of these reasonableness tests, as well as determining if you're a specified individual who is related to an individual who is connected. And then if you're between 18 and 24, you have that same test, although now if you were to pay, say, a dividend to that person and it becomes split income, and that child was to take that money and invest it somewhere, now anything that investment earns is now also considered back to being split income. So now you not only have to track what comes out of your company, you have to track the use of the funds that child gets to pay for it. So you can see these rules are particularly complicated to be able to track and manage and everything else, and this is why we've kind of pushed back when they came out with some of these rule changes to say this isn't really workable, you need to come up with a better answer, and so they've taken that to heart, we think. We'll find out when the draft legislation comes out whether that's going to happen or not. So again, I just kind of want to go through just a couple examples to maybe clarify what this means, because I know it's an extremely complicated new tax regime that we're not used to. So I'm going to go back again to this basic picture. And we have this corporation, and we have the specified individual that's going to receive income from the company, who's related to the connected individual who has that degree of influence over the corporation, okay? So that's what we had just kind of talked about. Now there's obviously those factors that, labor contributions, et cetera, that go into whether they can receive the money. And then on the degree of influence, again, we have, the earnings and the equity and the investment influences, et cetera. And so in our first example, we have Mr. and Mrs. A. Mr. A is active in day-to-day operations. Mrs. A is not. They own the company 50-50. They have an investment in the common shares that was nominal. They each put in their $100 for 100 shares. And dividends have been paid to each of them annually ever since. So now, are the dividends split income? So there's a couple of things that we're going to want to look at for each of them. Since they both own 50% of the shares, they're both definitely specified individuals. So now we immediately have to look to, is this split income? Because they're also connected individuals by owning more than 50% of the shares. So Mr. A works actively day to day, which allows him to have a labor contribution. but his capital contribution was negligible because he put in, $100. Now, the risk test, again, is extremely difficult to determine. And then, the amounts that he were paid before, well, if he's always taken this dividend, maybe that's okay. Maybe it's not. Maybe it's a reasonable dividend for a return based on what that type of company does in the industry. Maybe it's not. So, probably because he's active, it's okay. But we don't know. Maybe it's toasty. Maybe even though it's his business and he's actively involved, he might not be taking what a third party would be taking, and he could be sucked into these new rules and everything taxed at the high rate. I don't think that's going to happen in that case, but potentially he could. Now, with Mrs. A, I would say because she's no longer involved in the business, your argument would have to be that her past contributions allow her to continue to take funds out in the future. But is that a reasonable approach or not? I don't know. So likely Mrs. A is going to get caught under these new rules, and she's going to be subject to any dividends that she takes out to the high rate as opposed to any low rate marginal tax that she's allowed before. So the next example is Dad, who's the sole shareholder and the primary manager of the business, wants to transition it to his kids. Okay, so kid 1 works in the business, kid 2 doesn't. Now, once he's transitioned it, will dividends to child 1 and child 2 be caught under these new rules? Well, certainly child 1 and child 2 will be specified individuals because Dad would be the connected one and they would be related. And now we'd have to look to those other tests. So child 1, working actively in the business, depending on the amount of the dividend, likely going to be okay. Child 2, because they're not involved, we'd have to look back to, is Dad's capital contributions going to count towards kid 2 for his ability to take a dividend? And that's another thing where we don't know if that's going to be allowed or not. So I would lean towards it, yes, it would be allowed based on some other provisions that are in the Act, but until we see draft legislation, we don't know if that's going to be allowed or not. Now, the next example is kind of similar. A, B, and C are siblings, and they've each owned 1/3 of this operating company, but they received their shares for a nominal amount on an estate freeze that they did with their dad. So Dad and Mom have had all their shares redeemed, and A, B, and C have these nominal voting common shares. Now we have to look, do these new rules apply to this? Well, because these capital contributions from Dad were not really passed down based on death or some kind of gifting or planning, they were from basically buying Dad out of the business. Now you actually don't have a capital contribution there. And since A, B, and C just own it and they have a manager that runs it, they don't have capital and they don't have any labor contributions. So now they're stuck into this, they don't have any past history of earnings and they only have this risk assumed. So do they have substantial justification to assume that they have risk in OpCo because they own it and it could go under or not? Or is that enough risk for them to take a dividend? Maybe, maybe not. So there's a lot of questions that CRA kind of needs to answer around these new TOSI rules, for what we call them. So they haven't really defined what is a business. In the past, if you had, an investment company that owned, say, a commercial building, and that wasn't necessarily a business in their view, so then do you fall out of these rules or into them? And they need to clarify what that definition means. They need to clarify what it means to be actively engaged in that business. So what qualifies as active? How much time do you need to spend there? How much knowledge do you need to have in the operation, et cetera, a few of these things. The specified individual definition contains the words "a business," carried on in at the year or a previous year and at the time in the relevant year. And so again, what does this really mean? They definitely need to clarify what risk would be considered in the analysis of risk assumed. And they need to clarify what this past receipt of dividends or salaries actually means. And then to let us know, well, what happens if there's a one-time spike in the dividend amount paid to the shareholder? So again, you may have been talking to your accountants already and they say, oh, well, we'll just pay a really big dividend in 2017 and then you'll get access to all these marginal rates and then you can draw it out over the future years. Well, if we do that, does that screw up future planning, or does that trigger them to say, well, maybe we should be looking at this next year because their dividend amount dropped way off. So probably a lot more questions than there are answers at this point. But basically, if you have been using split income, so basically paying multiple family members out of your corporation, and it's involving anything other than salaries that are for fair market value for their work performed, you should be talking to your advisor and trying to get this adjusted. Again, once we know what this new legislation looks like, because right now they're not going to have any answers at this point either. So questions on that part before I jump to the next couple? Just a lot of confused people at this point.
When are these proposed changes?
So they propose that they're going to come in January 1st, 2018, which at this point leaves us 2 months to adjust to it if it happens, and that's based on depending on when they even get this legislation to us. So there's definitely going to be some thought that's going to need to go into all of this before Christmas. Okay.
Proprietorships, are they facing some of the same challenges as corporations?
So proprietorship or partnerships?
Either or, because there's all those structures out there.
Right, so partnerships, absolutely. Trust structures, absolutely. Proprietorships, not so much, because in theory, you can't really income split on a proprietorship. It's one individual's business. So they don't really address that. And again, it comes a little bit back to your definition of business being clarified, but likely you'd be fine in a proprietorship. Yep.
What's their motive? Because I've heard that the cost of change here is going to outweigh what they're actually supposedly going to gain.
Yeah, so now we're getting into a little bit of a political discussion. So I'll tiptoe as much as possible. So I guess if their motivation, I think, is if you look at purely from just tax and not from a broad perspective of the differences between a business owner and an employee, that a business owner has some perceived tax advantages that an employee wouldn't. So if we take these income splitting rules, well, if you own a business and you own it with your wife, you used to be able to split your drawings 50-50 out of your company, right? And you'd each use your marginal rates. Well, if your wife actually just stays at home and takes care of kids and house or whatever, well, if the employee is in the same situation, he can't take his T4 and divide it in half, right? So that's what they're looking at. But again, in my personal viewpoint, is it's a little short-sighted and it doesn't necessarily look at the entire picture, because it doesn't consider that individual that is a business owner takes a ton of risk involved in starting and running a business. Their house is on the line if something goes wrong with that business, or like an employee is not really in that situation. The business owner has no paid sick leave, no benefits, no defined pension plan where they're guaranteed to get X amount of dollars every month for the rest of their life as long as they're alive. So they're not really looking at necessarily the whole picture when they're looking at this particular example. Again, more my personal opinion than the actual fact, but I don't know, does that kind of help? Yeah.
Yeah, I don't necessarily have a question, but in response to that, because we've met with finance in Ottawa, and they are preoccupied with the concept of fairness in the Department of Finance. And I think they wanted to do this for a long time. And they finally found a minister in a government that would agree with them. And they went down this rabbit hole, and now they got into a jackpot. And it's a similar situation with deferred cash tickets, which they have not given an answer on yet. But it's the notion that, we used to have a wheat board, so we had deferred cash tickets. We don't have a wheat board anymore, so we don't need it. And farmers in Eastern Canada don't necessarily have this tool. It's only in the Canadian Wheat Board designated area, so it's, they're preoccupied with the notion of an even distribution of the tax system. So I think on this one, and again, we met with them in September. They had no idea what the unintended consequences were, and actually your company helped us make that case. So,
Yeah.
and the final thing I would say is it's rare when a bunch of accountants actually create a firestorm of political opposition or something.
Yeah, for sure.
So
Yeah,
thanks for doing that.
usually tax changes are good for us. So, but yeah, I think that's kind of the motivation, and there is a lot of things going on, and their view of fairness, and I mean, in fairness to them, the whole point of the Canadian Income Tax Act has always tried to be that no matter how you earn $1, you pay the same amount of tax on it, and they're trying to just kind of punch whatever their perceived holes in that are, and this was their attempt at it. That obviously some of it got pushed back enough that they backed away, and some not so much. One of the new things that did come out of their most recent comments was some changes to the small business deduction. So I think if you'll remember back a few years under Stephen Harper, he had proposed that the small business rate would actually go down over a period of years. When the Liberals came in, they actually put a stop to it. So it was, in Alberta, 14%, and it was supposed to come down to this 11% over time. Right now, in 2016, it was 13.5. In Alberta, the Alberta rate actually dropped, so it came down to 12.5, and now it's going to be 12 and then 11 going forward. So it's a good advantage to anyone that has access to the small business deduction for income in your corporation under $500,000. So that wasn't in their initial draft legislation, but it was a change that they came out with subsequent to that. The next thing is passive income. So this jumps back to me talking a little bit about no matter how you earn $1, you're paid the same amount of tax on it in Canada. So if you look at our chart, an employee that would earn $100 would have $48 of tax, and he'd have $52 left at the end of the day. Now this is assuming they're in the top tax bracket. All these tax rates are. If you earn less than $500,000 in a corporation, you would pay $100 in tax. You'd pay $12.50 in corporate tax. You'd have $87.50 left. You'd pull it out. You'd pay $36 on it. You'd have $51.50 left in your pocket. Now, if you earned income over $500,000 in a company at $100, you'd pay a 27% tax rate. You'd have $73 left. You'd pay $23 in personal tax, and you'd have $50 left in your pocket at the end of the day. So this is the concept of integration. So really, no matter how you're earning your money, you're going to pay the same amount of tax. Now, with passive income, what they're trying to, combat is that if you are to keep that money after corporate tax, so going back to the other chart, you'd have either, you have $52 left in your pocket, but if you don't take anything out, you could have 87 cents in your pocket or 73 cents in your pocket in your company to reinvest. So what they're saying is, well, you have an additional advantage by holding that deferral of tax in your company and not paying it out to yourself personally. And we don't like that you have that advantage because the average employee does not. So this is going to obviously impact privately owned corporations, but we have no draft legislation. Even in the other proposed documents, they had no draft legislation at all. They proposed a couple different methods. One is an extremely complicated method. It works for what they were trying to accomplish, but it's extremely complicated, and tracking it would be difficult, and your accountant's going to charge you a lot of money to do that. So it's really a disadvantage to the individuals to keep it in there. The other way, you either have to determine if you want a small business deduction or if you don't. But ultimately what they're trying to do is eliminate that deferral ability. And if you hold money in your company to reinvest it, they're going to tax you at a much worse tax rate than under what the current rules are. Now, when you earn inactive income, it's a little bit of a convoluted tax system of how you get taxed. So you get taxed at actually a really high rate in your company already. So you're taxed at about 50%. Then as you pay a dividend out to yourself personally, your company recovers 30% of that, and so it pays a net 20%, and then you pay at your marginal rate. So that system is our current system, which keeps all of that integration that we talked about intact. What they're proposing to do is get rid of that refundable pool, which is a 30%, so you would just pay tax at 50% in your corporation. and then also get rid of a capital dividend account. A couple minutes, okay. So what I guess I just want to explain passive income. So passive income is if you're renting out farmland, that's passive income. If you have investment in an account at RBC or BMO and it's earning dividends from stocks and interest and bonds, et cetera, that's passive income. If you have substantial oil lease or seismic income coming in, that's passive income. They did announce that AgriInvest is not going to be considered passive income. And some of the things that they just announced was with this is a safe harbor. So a safe harbor basically is the first $50,000 of passive income that you earn in a company is going to be okay. The next thing they announced is transitional rules. So any past investments that you had are going to be protected. They're not going to fall under these new rules, so they'll be sheltered. They did announce for the capital gains that if you sell a active business as opposed to selling a stock of RBC, you should still be able to keep your tax-free portion of that gain that can pay out to a shareholder. That should be staying intact. They mentioned that venture capitalists, they're going to fall under some different rules so that can continue to happen in Canada, and then your AgriInvest is going to be okay. So any questions on the small business deduction or on passive income?
So on passive income, or on land rental, say, if we go back to a crop share and they pay a little bit of expenses, they're going to get around that, or?
So technically a crop share is deemed as inactive income as well. So
If they're paying some expenses and.
yeah, well, I mean, then you'd have to make an argument that you're actually actively farming it and that this is just your arrangement that you have, which potentially could be made. I think you would have a hard time convincing CRA of that. You would probably need to do it in tax court, but I think you might be able to get there if you truly are like actively doing it. But I think that just paying a few expenses and taking a crop share probably wouldn't get you there.
That was my question. So what % will our landlords be taxed differently? How much is that?
Well, technically no different. Well, I mean, technically their spread is going to be, I guess, up to, they could be paying up to 73% tax, assuming on a flow-through basis where they pull it all out. So it could be a big number, assuming that the rules are what they kind of said, but we'll see. And depends what the land rent is, right? Because if it's under $50,000 net of their expenses, they're really not any different situation. But if they are, making hundreds of thousands of dollars in it, yeah, they may want to look at some alternative planning with individuals to maybe get themselves on side for some active farming.
Okay, unfortunately, we're going to have to
Cut me
Ryan
off.
here, but are you going to be around for a little bit?
Yeah, I'll stick around probably through the lunch break, so you can find me and we can talk some more about personal situation or whatever you want. Thanks, everybody.